Okay, let's continue to talk about goodwill, and we're going to kind of work on some examples. As a reminder, goodwill is measured as the excess of the cost of the purchase over the fair market value of the identifiable net assets. What are net assets, by the way? Those are assets minus liabilities. Okay, so goodwill is measured as the cost of the purchase over the fair market value of the identifiable net assets purchased. Okay. Now remember, we can only recognize goodwill when we are acquiring an entire outside business entity. Okay. Internally generated goodwill should not be capitalized. So let's take a look at an example when we are acquiring a business. Okay. Multi-Diversified Inc. decides that it needs a parts division to supplement its existing tractor distributorship. The president of Multi-Diversified is interested in buying Tractorling Company. The illustration below presents the statement of financial position of Tractorling Company. Okay, so this is the balance sheet of the company that we will be obtaining or purchasing. Okay, now obviously you guys know that things are listed on the balance sheets at their book value, which is a lot of times their cost or whatever. Okay, or cost less accumulated depreciation or whatever. Okay, balance sheet lists assets and liabilities at their book value. Okay, now the fair value of the net assets that we are obtaining are listed here below. Okay, now I want to look at a couple things here. Take a look at the fair value. Now again, fair value is more of a market generated measurement. More of what it would be worth in the market or what it would take to pay it off in the market or whatever. Take a look at the fair value for cash, accounts receivable, and for liabilities. Okay, these are the fair values, and that's 25, 35, and 55. Now let's go back to the balance sheet. You can see that cash, accounts receivable, and liabilities, that the book values are also 25, 35, and 55,000 respectively. Okay, many times the book value equals the fair market value of things like cash, accounts receivable, and current liabilities. Okay, it's going to be in these assets, for example, right here, inventory and property, plants, and equipment, that the book value is going to be different than the fair market value. Okay, and this kind of makes sense. Okay, for example, if you were going to purchase cash from me, I know that sounds kind of weird, but let's say I had $25,000 of cash, and that's what it's on my books at, $25,000. Well, how much is the fair market value of that? Well, it's $25,000, right? But I might have an automobile on my books at a book value of $32,000, and the market value could be drastically different. Could be more or could be less. Okay, so those sort of things like inventory and PP&E, the book values could be greatly different than the fair market value, and that's what we have here. Look at the book value for inventory and for PP&E. It's 42 and 153, right? Well, look what the fair market value is for those items. It's 122 and 205. Okay, it's quite a bit different, isn't it? Now, also they tell us that we are obtaining in this acquisition a patent for $18,000. Okay, now why did that patent not appear on the balance sheet? Well, more than likely the reason is because it was an internally generated internal asset of a patent, and a lot of times internally generated intangible assets cannot be recognized. But once that company is being purchased by an outside entity, that can prompt recognition of that. Okay, so the fair value, again, more of a market-driven approach. The fair value of the net assets, which is your assets less your liabilities, is $350,000. Now, how much are we paying for it? We're paying 400,000. Okay, so the 400,000 is different than the fair value of the identifiable net assets by 50 grand, and it's greater. The purchase price is greater than the fair value of the net identifiable assets. So we have goodwill that will be recognized of $50,000. Okay? Now, when we record this journal entry on our books, I want you to recognize that cash goes on the books, accounts receivable goes on the books, inventory goes on the books, property, plant, and equipment goes on the books, patents goes on the books, liabilities goes on the books. Those things all go on the books at their fair value, which is listed right here. Okay? They all go on the books at their fair value. Yes, for a few of those, fair value is also equal to book value, but they go on at the fair market value. Okay? Now, notice that we did not bring over, look at the original balance sheet. We did not bring over capital stock and retained earnings. Okay? And now the way they listed their PP&E, it's a net amount. But never would you, in your journal entry, be bringing over accumulated depreciation either. You'd just be bringing over property, plants, and equipment. Okay? But these are all at their fair market value. So that's the first thing that we do. The next thing that we do is bring or recognize the cash that we paid for this company. Well, we paid $400,000 for it. Okay? Well, goodwill then, as we said in a previous video, is a residual amount. It's kind of the plug that we have to put in this journal entry to make the debits equal the credits to make it equal. Okay? So goodwill is something that is really calculated by doing all these other things, looking at the cash paid compared to the fair market value of the net assets. All right? That's not too tough, is it? You have one of those, I know, in your book. Okay? Let's look at another quick example. Okay, Global Corporation purchased the net assets of local company for $300,000. That's how much we paid, $300,000. Now the balance sheet just prior to acquisition of local company is right here. So that's the book value. Okay? That's the book value. Now they also listed here to the side fair market value. Now don't think that fair market value is going to be listed on the balance sheet. It's not. The balance sheet is, this is the balance sheet right here. Okay? That would be the balance sheet. Okay? The fair market values, they just happened in this slide to list those right by it. And you can see, as I said before, the fair market value equals the cost for cash, for receivables, for accounts payable. But these guys right here, the cost is different than the fair market value. Okay? Which is what we'd expect. Okay? And once again, we're not going to bring over common stock or retained earnings. Okay, so what we have here is the fair market value is $200,000. We're paying $300,000, so we're going to have goodwill recognized of $100,000. Okay? What they're trying to get across with this slide is the purchase price the difference between the purchase price and the fair value is what is recorded as goodwill, not the difference between book value and purchase price. Okay? Now you're right, there is a difference between the book value and the fair value of $70,000, but that doesn't go towards goodwill. That's just a revaluation that occurs. The goodwill is recorded at the difference between the fair value of the net assets and the purchase price. Okay? So once again, our purchase price is greater than our fair market value of those net assets, so we have goodwill recorded of $100,000. The journal entry would look like this. Okay? Whoops. Back up a little bit. Okay, these items are going on at fair market value. Then we record the amount of cash that we paid out. In this case, 300,000. Goodwill goes on the books as sort of a plug or a residual amount. Okay? Goodwill can only be recognized when you are acquiring a company. Okay? So hopefully that helps.